Hello friends, today in this video we shall discuss Accounting Standard 29, which deals with provisions, contingent assets and contingent liabilities. Let's see what the accounting standard prescribes about those items. First of all, objective. The objective of this standard is to ensure that appropriate recognition criteria and measurement bases are applied to provisions and contingent liabilities, and that sufficient information is disclosed in the notes to financial statements to enable users to understand their nature, timing, and amount. The objective of this standard is also to lay down appropriate accounting for contingent assets. So this is objective. Now scope. This standard should be applied in accounting for provisions, contingent liabilities, and in dealing with contingent assets, except those resulting from financial instruments that are carried on at fair value. Except those resulting from executory contracts, except where the contract is onerous. Explanation here: onerous contract means here in onerous contract is a contract in which the unavoidable cost of meeting the obligation under the contract exceed the economic benefit expected to be received under it. Thus, for a contract to qualify as an onerous contract, the unavoidable cost of meeting the obligation under the contract should exceed the economic benefit expected to be received under it. The unavoidable cost under a contract reflect the least net cost of existing from the contract, which is the lower of the cost of fulfilling it, and any compensation or penalties arising from failure to fulfill it. Now explanation 2. If an enterprise has a contract that is onerous, the present obligation under the contract is recognized and measured as a provisions as per this statement. So as per this accounting standard, onerous contract is considered as provision it is recognized and measured as provision. But executory contracts is out of the scope of this standard. So again, the standards should be applied in accounting for provisions and contingent liabilities and dealing with contingent assets, except this one, and except those arising in insurance enterprises from contract with policy holders, for contract with policy holders, except those covered by another accounting standards. So this accounting standard does not apply to these cases where another accounting standard is applied. In case of insurance enterprise, contingency arising from policyholders, this is not covered in this accounting standard. This standard applies to financial instrument, including guarantees that are not carried at fair value. Executory contracts are contracts under which neither party performed any of its obligations or both parties have partially performed their obligations to an equal extent. This standard does not apply to executory contract unless they are onerous. This standard applies to provisions, contingent liabilities, and contingent assets of insurance companies other than those arising from contract with policyholders. Where another accounting standard deals with a specific type of provisions, contingent liability or contingent asset, an enterprise applies that standard instead of this standard. For example, certain types of provisions are also addressed in accounting standards construction contract, taxes on income accounting standard, accounting for taxation on income, leases accounting standard. However, accounting standard 19, which is leases accounting standard, contains no specific requirement to deal with operating leases that have become onerous. This standard applies to such cases. Retirement benefit accounting standard Accounting Standard 15, accounting for retirement benefit in the financial statement of the employees. So these are the standards. So when specific provision has been dealt with in this standard, then the provisions in these standards have not applied to those cases. Some amount treated as provisions may relate to recognition of revenue. Some amount treated as provision may relate to recognition of revenue. For example, where an enterprise gives guarantees in exchange for a fee, this standard does not address the recognition of revenue. Accounting Standard 9, revenue recognition, identifies the circumstances in which revenue is recognized and provides practical guidance on the application of recognition criteria. This standard does not change the requirement of Accounting Standard 9. This standard defines the provision as liability, which can be measured only by using a substantial degree of estimation. The term provision is also used in the context of items such as depreciation, impairment of asset, doubtful debts. These are adjustment to the carrying amount of assets and are not addressed in this standard. These are not addressed in this standard. Other accounting standards specify whether expenditure are treated as assets or expense. Other accounting standards specify whether expenditure are treated as assets or expense. These issues are not addressed in this standard. Accordingly, this standard neither prohibits nor requires capitalization of cost recognized when a provision is made. This standard applies to provisions for restructuring, including discontinuing operation. This standard applies to provisions for restructuring, including discontinuing operation. Where a restructuring meets the definition of discontinuing operation, additional disclosure are required by Accounting Standard 24, discontinuing operation. Let's see some definitions of this standard. Provisions. Provision is a liability which can be measured only by using a substantial degree of estimation. Liability. Liability is present obligation of the enterprise arising from past event. the settlement of which is expected to result in an outflow from the enterprise of resources embodying economic benefits. So liability is present obligation of the enterprise arising from past event, settlement of which is expected to result in outflow from the enterprise of resources embodying economic benefits. An obligating event is an event which creates an obligation that results in an enterprise having no realistic alternative to settling that obligation. Contingent liability. Contingent liability is possible obligation that arises from the past event and the existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the enterprise. Or contingent liability is a present obligation that arises from the past event but is not recognized but it is not recognized because it is not probable that outflow of resources embodying economic benefit will be required to settle the obligation, or it is not recognized because it is because reliable estimate of the amount of obligation cannot be made. A reliable estimate of the amount of obligation cannot be made. Contingent asset. Contingent asset is possible asset that arises from past event, the existence of which will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the enterprise. Present obligation. It is an obligation. An obligation is a present obligation if, based on the evidence available, its existence at the balance sheet date is considered probable, that is more likely than not. An obligation is possible obligation if, based on evidence available, its existence at the balance sheet date is considered not probable. Now restructuring. Restructuring is a program that is planned and controlled by the management and materially changes either the scope of the business undertaken by an enterprise or the manner in which business is conducted. Obligation is a duty or responsibility to act or perform in a certain way. The obligation may be legally enforceable as a consequence of binding contract or statutory requirement. Obligation also arises from normal business practice, custom, or a desire to maintain good business relation or act in an equitable manner. So obligation arises from normal business practice, custom, and desire to maintain good business relation or to act in equitable manner. Provisions can be distinguished from other liabilities such as trade payable, accruals, because in the measurement of provisions, substantial degree of estimation is involved with regard to future expenditure required in settlement. By contrast, trade payables are liabilities to pay for goods or services that have been received or supplied and have been invoiced or formally agreed with the supplier. Accruals, by contrast, accruals are liabilities to pay for goods or services that have been received or supplied but have not been paid, invoiced, or formally agreed with the supplier, including the amount due to the employees. Although it is sometimes necessary to estimate the amount of accruals, the degree of estimation is generally much less than that for provision. In this standard, the term contingent is used for liabilities and assets that are not recognized because their existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the enterprise. In addition, the term contingent liability is used for liabilities that do not meet the recognition criteria. Now, recognition of provision. A provision should be recognized when an enterprise has present obligation as a result of past event. It is probable that outflow of resources embodying economic benefits will be required to settle the obligation. A provision should be recognized when a reliable estimate can be made of the amount of obligation. So, reliable estimate can be made of the amount of obligation. If these conditions are not met, no provision should be recognized. If these conditions are not met, no provision should be recognized. Present obligation. Almost in all cases, it will be clear whether a past event has given rise to present obligation. In almost all cases, it will be clear whether a past event has given rise to present obligation. In rare cases, for example, in a lawsuit, it may be disputed either whether certain events have occurred or whether those events results in present obligation. In such cases, the enterprise determines whether present obligation exists at the balance sheet date by taking into account all the available evidence, including, for example, the opinion of experts. The evidence considered includes any additional evidence provided by the event after balance sheet date. On the basis of such evidence, where it is likely, where it is more likely than not that a present obligation exists at the balance sheet date, the enterprise recognizes provisions if recognition criteria are met. On the basis of such evidence, where it is more likely that no present obligation exists at the balance sheet date, the enterprise discloses contingent liability unless the possibility of outflow of resources embodying economic benefit is remote. Past event. A past event that leads to present obligation is called obligating event. A past event that leads to present obligation is called obligating event. For an event to be obligating event, it is necessary that enterprise has no realistic alternative to settling the obligation created by the event. Financial statements deal with financial position of the enterprise at the end of the reporting period, not its possible position in the future. Financial statements deal with financial position of an enterprise at the end of its reporting period, not its possible position in the future. Therefore, no provision is recognized for costs that need to be incurred to operate in the future. Only liabilities recognized in the enterprise's balance sheet. Only liabilities recognized in enterprise's balance sheet are those that exist at the balance sheet date. It is only those obligations arising from past events existing independently of the enterprise's future action. It is only those obligations arising from the past event existing independently of the enterprise's future action, that is, future conduct of its business, that are recognized as a provision. It is only those obligation arising from past event existing independently of an enterprise's future action that are recognized as provisions. Examples of such obligations are penalties or cleanup cost for unlawful environmental damage, both of which would lead to an outflow of resources embodying economic benefits. In the settlement, regardless of future action of the enterprise. Similarly, an enterprise recognizes provision for the decommissioning cost of an oil installation to the extent that the enterprise is obliged to rectify damage already caused. In contrast, because of commercial pressure legal requirement, an enterprise may intend or need to carry out expenditure to operate in a particular way in the future. For example, by setting smoke filters in a certain type of factory. Because the enterprise can avoid the future expenditure by its future action, for example, by changing its method of operation, so it has no present obligation for that future expenditure and no provision is recognized. An obligation always involves another party to whom the obligation is owed. It is not necessary, however, to know the identity of the person to whom the obligation is owed. Indeed, the obligation may be to the public at large. An event that does not give rise to an obligation immediately may do so at a later date. An event that does not give rise to an obligation immediately may do so at a later date because of changes in the law. An event that does not give rise to obligation immediately may do so at a later date because of changes in the law. For example, when environmental damage is caused, there may be no obligation to remedy the consequences. There may be no obligation to remedy the consequences. However, causing of damage will become an obligating event when a new law requires the existing damage to be rectified. Where details of proposed new law have yet to be finalized, an obligation arises only when legislation is virtually certain to be enacted. The differences in circumstances surrounding enactment usually make it impossible to specify a single event that would make the enactment of law virtually certain. Differences in circumstances surrounding the enactment usually make it impossible to specify a single event that would make the enactment of law virtually certain. In many cases, it will not be possible to be virtually certain of the enactment of law until it is enacted. In many cases, it will be impossible to be virtually certain of the enactment of law until it is enacted. Possible outflow of resources embodying future economic benefits. Embodying economic benefits. For a liability to qualify recognition, for a liability to qualify for recognition, there must be not only a present obligation. For a liability to qualify for recognition, there must be not only a present obligation but also the probability of outflow of resources embodying economic benefit to settle that obligation. For a liability to qualify recognition, there must be not only present obligation but also the probability of outflow of resources embodying economic benefit to settle that obligation. For the purpose of this standard, an outflow of resources or other event is regarded as probable if event is more likely than not to occur. That is, the probability that event will occur is greater than the probability that it will not. Where it is not probable that a present obligation exists, where it is not probable that a present obligation exists, an enterprise discloses a contingent liability unless the possibility of outflow of resources embodying economic benefits is remote. Where there is a number of similar obligations, product warranties, for example, or similar contracts, there are a number of obligations. The probability that outflow will be required in settlement is determined by considering the class of obligations as a whole. Where there is a number of similar obligations, the probability that outflow will be required in settlement is determined by considering the class of obligation as a whole. Although the likelihood of outflow for any item may be small, it may well be probable that some outflow of resources will be needed to settle the class of obligations as a whole. If it is the case, a provision is recognized if other recognition criteria obviously meet. Reliable estimate of obligation. Reliable estimate of obligation. The use of estimate is essential part of preparation of financial statement. Use of estimate is essential part of preparation of financial statement and does not undermine their reliability. This is especially true in case of provisions. which by their nature involve a greater degree of estimation than most other items. Except in extremely rare cases, an enterprise will be able to determine a range of possible outcomes and can therefore make an estimate of their obligations that is reliable to use in recognizing a provisions. In extremely rare case where no reliable estimate can be made, a liability exists that cannot be recognized. That liability is disclosed as contingent liability. Now, recognition of contingent liability. An enterprise should not recognize contingent liability. A contingent liability is disclosed as required by para 68 unless the probability of outflow of resources embodying economic benefit is remote. Where an enterprise is jointly and severally liable for an obligation, the part of obligation that is expected to be met by other parties is treated as contingent liability. The enterprise recognizes a provision for the part of obligation for which an outflow of resources embodying economic benefit is probable, except in extremely rare circumstances where no reliable estimate can be made. Contingent liability may develop in a IA not initially expected. Therefore, they are assessed continually to determine whether an outflow of resources embodying economic benefits has become probable. If it becomes probable that outflow of future economic benefits will be required for an item previously dealt with as contingent liability, the provision is recognized in accordance with para 14 in the financial statement of the period in which the change in probability occurs, except in extremely rare circumstances where no reliable estimate can be made. Now, contingent assets. Enterprise should not recognize contingent asset. Contingent asset usually arise from unplanned or other unexpected event that give rise to possibility of inflow of economic benefit to the enterprise. An example is claim that an enterprise is pursuing through legal process where the outcome is uncertain. Contingent assets are not recognized in financial statement since it may result in recognition of income that may never be realized. However, when realization of income is virtually certain, then related asset is not contingent assets and its recognition is appropriate. And a contingent asset is not disclosed in the financial statement. It is usually disclosed in the report of approving authority, that means board of directors in case of company, and the corresponding approving authority in case of any other enterprise. It is not usually disclosed in the report of approving authority. It is usually disclosed in the report of approving authority where inflow of economic benefits is probable. Where inflow of economic benefits is probable. Contingent liability are assessed continually. Contingent assets are assessed continually if it has become virtually certain that inflow of economic benefits will arise. The assets and the related income are recognized in the financial statement of the period in which changes occur. Now, measurement best estimate. The amount recognized as provisions should be best estimate of the expenditure required to settle the present obligation at the balance sheet date. The amount of provisions should not be disclosed to its present value. The estimate of outcome and financial effect are determined by judgment of management of the enterprise, supplemented by experience of similar transaction, or in some cases, reports from independent experts. The evidence considered includes any additional evidence provided by the events after balance sheet date. The provision is measured before tax. Tax consequences of the provision and changes in it are dealt with accounting standard 22, accounting for taxes on income. Risks and uncertainties. Risks and uncertainties that inevitably surround many events and circumstances should be taken into account in reaching the best estimate of the provision. In reaching the best estimate of the provision. Risk describes variability of outcome. A risk describes variability of outcome. A risk adjustment may increase the amount at which the liability is measured. Caution is needed. Caution is needed in making judgment under the conditions of uncertainty so that income or assets are not overstated and expense or liabilities are not understated. However, uncertainty does not justify the creation of excessive provision or deliberate overstatement of liabilities. For example, if proposed cost of a particularly adverse outcome are estimated on a prudent basis, if projected cost of a particularly adverse outcome are estimated on a prudent basis, that outcome is not then deliberately treated as more probable than is realistically the case. The care is needed to avoid duplicating adjustment for risk and uncertainty with consequent overstatement of provision. Disclosure of uncertainties surrounding the amount of expenditure is made under para 67B. Future events that may affect the amount required to settle an obligation. Future events that may affect the amount required to settle an obligation should be reflected in the amount of provision where there is sufficient objective evidence that they will occur. Future events that may affect the amount required to settle obligations should be reflected in the amount of provision where there is a sufficient objective evidence that they will occur. Expected future event may be particularly important in measuring provision. Expected future events may be particularly important in measuring event. For example, an enterprise may believe that cost of cleaning up a site at the end of its life will be reduced by future changes in technology. The amount of recognized reflects the reasonable expectation of technically qualified and objective observers. The amount recognized reflects the reasonable expectation of technically qualified objective observers, taking account of all available evidence as to the technology that will be available at the time of cleanup. Thus, it is appropriate to exclude for example, expected cost reduction associated with increased experience in applying the existing technology, or the expected cost of applying existing technology to a larger or more complex cleanup operation than has previously been carried out. However, an enterprise does not anticipate the development of completely new technology for cleaning up unless it is supported by sufficient objective evidence. The effect of possible new legislation is to take into consideration in measuring existing obligation. The effect of possible new legislation. The effect of possible new legislation is taken into consideration. The effect of possible new legislation is taken into consideration in measuring the existing obligation, and when sufficient objective evidence exists that legislation is virtually certain to be enacted. Effect of possible legislation is taken into consideration in measuring existing obligation when sufficient objective evidence exists that the legislation is virtually certain to be enacted. The variety of circumstances that arise in practice usually makes it important to specify a single event. The variety of The variety of circumstances that arise in practice usually make it impossible to specify a single event that will provide sufficient objective evidence in every case. Sufficient objective evidence in every case. Evidence is require both of what legislation will demand and of whether it will virtually certain to be enacted and implemented in due course. Evidence is require both of what legislation will demand or of whether it will virtually certain to be enacted and implemented in due course. In many cases, sufficient objective evidence will not exist until new legislation is enacted. In many cases, sufficient objective evidence will not exist until new legislation is enacted. Now, expected disposal of assets. Gain from expected disposal of asset should not be taken into account in measuring a provision. Gain from expected disposal of asset should not be taken into account in measuring a provision. Gains on expected disposal of asset should not be taken into account in measuring a provision, even if the expected disposal is closely linked to the event giving rise to provision. Instead, an enterprise recognizes gain on expected disposal of asset at the time specified by the accounting standard dealing with assets concerned. Reimbursement, where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party, and the reimbursement should be recognized when and only when it is virtually certain that reimbursement will be received. If the enterprise settles the obligation, where some or all of the expenditure required to settle provision is expected to be reimbursed by another party, the reimbursement should be recognized when and only when it is virtually certain that reimbursement will be received if the enterprise settles the obligation. The reimbursement should be treated as a separate asset. The amount recognized for reimbursement should not exceed the amount of provision. Amount recognized for reimbursement should not exceed the amount of provision. In the statement of profit and loss, the expense relating to provision may be presented net of amount recognized for a reimbursement. Sometimes an enterprise is able to look at another party to pay part or all of the expenditure required to settle a provision. For example, through insurance contract, indemnity clauses, or suppliers warranties. The other party may either reimburse amount paid by the enterprise or pay the amount directly. In most cases, the enterprise will remain liable for the whole of the amount in question, so that the enterprise would have to settle the full amount if the third party failed to pay for any reason. In this situation, a provision is recognized for full amount of the liability, and a separate asset for the expected reimbursement is recognized when it is virtually certain that reimbursement will be received if the enterprise settles the liability. In some cases, enterprise will not be liable for cost in question if third party fails to pay. In some cases, enterprise will not be liable for cost in question if third party fails to pay. In such cases, the enterprise has no liability for those costs. They are not included in provision. As noted para 28, an obligation for which enterprise is jointly and severally liable is a contingent liability to the extent that it is expected that the obligation will be settled by other parties. Now, changes in provision. Provisions should be reviewed at the balance sheet date and adjusted to reflect the current best estimate. Changes in the provision should be reviewed at each balance sheet date and adjusted to reflect the current best estimate if there is no longer probable that an outflow of resources embodying economic benefit will be required to settle the obligation. The provision should be reversed. Use of provisions should be used only for expenditure for which provision was originally recognized. Use of provision. Only expenditure that relate to original provision are adjusted against it. Only expenditure that relate to original provision are adjusted against it. Adjusting expenditure against a provision that is originally recognized for another purpose would cancel the impact of two different events. Only expenditure that relate to original provision are adjusted against it. Adjusting expenditure against a provision that was originally recognized for another purpose would cancel the impact of two different events. Application of recognition and measurement rules. Future operating losses. Provisions should not be recognized for future operating losses. Future operating losses don't meet the definition of a liability in para 10. The general recognition criteria for provision in para 14. The expectation of future operating loss is an indication that certain asset of the operation may be impaired. An enterprise tests this asset for impairment under accounting standard 28. Impairment of asset. Restructuring. Following are the examples of events that may fall under the definition of restructuring. Sale or termination of line of business. Closure of business location in a company or region, or the relocation of business activities from one country to another or region to another. Changes in management structure, for example, eliminating a layer of management. This is also restructuring. Fundamental reorganization that have material effect on the nature and locus and focus of the enterprise's operation, fundamental reorganization that have effect on the material effect on the nature and focus of the enterprise operation, fundamental reorganization. This is also restructuring provision. A provision for restructuring cost is recognized only when the recognition criteria for provision are set out in para 14 are met. No obligation arises for sale of operation until the enterprise is committed to the sale, that is, there is binding sale agreement. An enterprise cannot be committed to sale until the purchaser has been identified and there has been binding sale agreement. Until there is a binding sale agreement, the enterprise will be able to change its mind and indeed will have to take another course of action if the purchaser cannot be found on acceptable terms. When the sale of an operation is envisaged as a part of restructuring, the asset of operation are viewed for impairment under the accounting standard 28. Restructuring provisions should include only the direct expenditure. Restructuring provisions should include only direct expenditure arising from restructuring, which are those that are both necessarily entailed by restructuring and not associated with ongoing activities of the enterprise. Restructuring provision does not include such costs as retaining, relocating, continuing staff, marketing, investment in new system and distribution networks. These expenditures relate to future conduct of business and are not liabilities of the restructuring, liability for restructuring at the balance sheet date. Such expenditures are recognized on the same basis as if they arose independently of the restructuring. Such expenditures are recognized on the same basis as if they arose independently of restructuring. Identifiable future operating loss up to the date of restructuring are not included in the provision. Identifiable future operating loss up to the date of restructuring are not included in provision. As required by para 44, gains on the expected disposal of assets are not taken into account. In measuring the restructuring provision, even if sale of asset is envisaged as a part of restructuring, now disclosures for each class of provision, an enterprise should disclose carrying amount at the beginning and at the end of the period. Additional provision made in the period, including increase to the existing provision. Enterprise should disclose amount used, incurred and charged against provision, amount used during the period. Enterprise should disclose unused amount reversed during the period. Provided that small and medium-sized company as defined is notification may not comply with the paragraph 66 above, an enterprise should disclose following for each class of provision: a brief description of the nature of obligation and the expected timing of any resulting outflow of economic benefits, an indication of uncertainties about those outflows where necessary to provide adequate information. When necessary to provide adequate information, an enterprise should disclose the major assumption made concerning future events as addressed in para 41. The amount of any expected reimbursement, stating the amount of any asset that has been recognized for that expected reimbursement, provided that small medium-sized company as defined in notification may not comply with para 67 above 68 unless the possibility of any outflow in settlement is remote. An enterprise should disclose each class of contingent liability at the balance sheet date, a brief description of the nature of contingent liability, and where practicable, an estimate of its financial effect measured under para 35 to 45. Where practicable, enterprise should disclose indication of the uncertainties relating to any outflow. Where practicable, it should disclose the possibility of any reimbursement. In determining which provisions or contingent liability may be aggregated to form a class, it is necessary to consider whether the nature of items is certainly similar for a single statement about them to fulfill the requirement of para 67A, B, 68AB. Thus, it is appropriate to treat as a single class of provision amount relating to uncertainties of different products, but it would not be appropriate to treat as single class amount relating to normal warranties and the amount that are subject to legal proceedings. Where a provision and contingent liability arise from same set of circumstances, an enterprise makes disclosures required by para 66 to 68 in a IA that shows link between the provision and contingent liability. Where any of the information required by para 68, where any of the information required by para 68 is not disclosed because it is not practicable to do so, that fact should be stated. In extremely rare cases, disclosure of some or all of the information required by para 66 to 70 can be expected to prejudice seriously the position of the enterprise in a dispute with other parties on the subject matter of provisions or contingent liability. In such cases, the enterprise need not disclose the information but should disclose the general nature of the dispute together with the fact that and the reason why the information has not been disclosed. So that's all about accounting standard 29 provisions, which deals with provisions, contingent asset, contingent liability. So thank you for watching.